Both Peter Lynch and Warren Buffett are legendary investors who have achieved remarkable success in the stock market. While their investment philosophies share some similarities, there are also distinct differences in their approaches. Let's compare their ways to invest. Peter Lynch is known for his active management style and is famous for his work as the manager of the Fidelity Magellan Fund from 1977 to 1990. His investment philosophy emphasizes the concept of invest in what you know. Lynch believed that individual investors have an advantage by investing in companies they understand and products they use in their everyday lives. Lynch advocated for a bottom-up approach, where investors should focus on researching individual companies rather than trying to time the market. He was a proponent of finding multibaggers, which are stocks that can increase in value several times over. Lynch believed in looking for undervalued companies with strong growth potential, healthy financials, and a competitive advantage in their industry. Let's listen what he said in 2019.
In the stock market, the most important organ is the stomach. It's not the brain. There's always, on the way to work, the amount of bad news you can hear is almost infinite now. So the question is, can you take that? I mean, do you really have faith that 10 years, 20 years, 30 years from now, common stocks are a place to be? If you believe in that, you should have some money in equity funds. I mean, it's a question, what's your tolerance for pain? I mean, the stock market's a very good place to be, but I can toss a coin now. Is it going to be lower 2 years from now? Higher? I don't know. More people lost money waiting for corrections and anticipating corrections than the actual corrections. Well, you ought to look in the mirror every day and say, what am I going to do if the market goes down 10%? What do you do if it goes down 20? Am I going to sell? Am I going to get out? If that's your answer, you should be reducing it today. Well, I had this perfect record. I think the 13 years I ran Magellan, the market went down 9 times, 10% or more. I had a perfect record. I went down more than the market. Every time I went down more. So I just didn't worry about it. The point is, would you say to yourself, do I need this money in a year? Do I need this money in 2 years? Do I need this money in 3 years? So my longer term stock market's been the best place to be last 10 years, last 30 years, last 130 years. But if you need the money in 1 or 2 years, you shouldn't be buying stocks. You should be in a money market fund. Well, I think emerging markets, and that's not my expertise, but I mean, these markets have been really hammered. You know, and a lot of countries are doing a lot better. You know, I mean, so I think there's potential there. That's not my expertise, but I think emerging markets could be a place to research. I never looked at the economy. I want to find out, the only thing I would look at what's happening right now. You know, what's going to happen a year from now? What's going to happen to interest rates? I'd love to get next year's Wall Street Journal. I'd pay an extra $1 for it. That'd be very helpful. I don't know what's going to happen in the future, but I want to find right now. Well, I think anybody that's investing in the stock market has to understand, you buy a company. These are not lottery tickets. Behind every stock there's a company. If the company does well, over time the stocks do well, and vice versa. You have to look at the company. That's what you're researching. That's what we do at Fidelity. That's what I do. You could be an interventional cardiologist, and you're putting in Abiomed, Impella. You say, wow, this really is an incredible breakthrough, preventing shock, preventing hemodynamic support. It's amazing. It's a breakthrough. It's great. It works. But you're actually using it. I mean, or you're assisting. You're in the operating room seeing this breakthrough. That's, you saw way ahead of most people. That's an edge. You need an edge on something. Well, the data now is so good. I remember when we owned Nike, we had to wait for the mail to come to our library. Now, when somebody reports earnings, it's telecast all over the world. They have an investor presentation, they show a balance sheet. So information is much better. So theoretically, the individual's edge has improved in the last 20, 30 years versus the professional. The data is there. It's free. But I think a lot of people, their problem is they have so many prejudices, there's so many biases. They won't look at a railroad. They won't look at an oil company. They won't look at a steel company. They're only going to look at companies growing 40% a year. They won't look at turnaround. So one thing, you just don't have so many prejudices and biases. I bought companies with unions. You have to really be agnostic. And a lot of people, they're just not flexible. I think flexibility is, and that's why Fidelity's had so many great fund managers. They're very flexible what they'll look at.
Other great investor, Warren Buffett, often referred to as the Oracle of Omaha, is the chairman and CEO of Berkshire Hathaway. He is a value investor who follows a more conservative and long-term approach to investing. Buffett's philosophy centers around buying high-quality companies at reasonable prices and holding on to them for the long haul. Buffett is known for his emphasis on the intrinsic value of a company. He seeks businesses with durable competitive advantages, referred to as economic moats, strong management teams, and a history of consistent earnings growth. Buffett's approach also involves a focus on businesses with predictable cash flows. He has famously said, "Our favorite holding period is forever," highlighting his belief in the power of long-term investing.
Unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. I mean, we found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I mean, I'm not sure that I'm not sure will be a great technique. I mean, it may be great if you inherit it. Paul Getty inherited the money at the bottom in 32. I mean, he didn't inherit it exactly. He talked his mother out of it, but and for example, a good example might be Coca-Cola. I think a number of people might have thought Coca-Cola was repurchasing shares at a very high price because they'll look at book value or PE ratios. But there's a lot more to intrinsic value than book value and PE ratios. And anytime anybody gives you some simplified formula for figuring it out, forget it. You have to understand the business. The people who understood that business well, the management, have understood and been very forthright about saying so over the years, that by repurchasing their shares, they are adding to the value per share for remaining shareholders. And like I say, people who didn't understand Coca-Cola or who thought mechanistic methods of valuation should take precedence, really misjudged the value to the Coca-Cola company of those repurchases. So we favor, when you have a wonderful business, we favor using funds that are generated at that business to make the business even more wonderful, and we favor repurchasing shares if those shares are below intrinsic value. And I would say that if it's a really wonderful business, we probably come up with higher intrinsic values than most people do. We have great respect, Charlie and I think it's developed over the years. We have enormous respect for the power of a really outstanding business, and we recognize how scarce they are. And if a management wishes to further intensify our ownership by repurchasing shares, we applaud. We just went over 8% of the Coca-Cola company, probably in the last 3 or so months, by a very tiny fraction. But we had a second purchase one time. But our percentage interest in the Coca-Cola company has gone up significantly through their repurchases, and we are better off because they have bought those shares at what looked like, to some people, perhaps high prices. And we thought they were wrong at the time, and I think now it's been indicated that or proven. So I urge you, if you're trying to decide on the wisdom of repurchases or of share issuances, that you don't think in terms of book value, you don't think in terms of specific PEs, you don't think in terms of any little model, but you think in terms of what would you really, pick businesses you can understand, and then think what you really would pay to be in those businesses. And that's what counts over time, is whether the repurchases are made at a discount from that figure. And I would say with the companies that we own shares in, our interest in Geico went from 33 or so percent to 50% over a 15-year or so period, simply through repurchases, and we benefited significantly. So did every other shareholder, I might add, that stayed with the company, and we benefited in no way disproportionate to them. But that was a very wise action on their part. And there too, they were all usually buying that stock at least double book value. And you could compare it to other insurance stocks and say, well, that's too much to pay. But GEICO wasn't an insurance company. It was comparable to other insurance companies. It was a very different sort of business. And they were very wise, in my view, to be following that course of action.
While both Lynch and Buffett believe in investing in good companies for the long run, there are differences in their approaches. Lynch's style is more growth-oriented and involves actively seeking out opportunities among smaller and potentially faster-growing companies. Buffett's style is more value-oriented, focusing on established companies with strong fundamentals and a history of success. In summary, both Peter Lynch and Warren Buffett are successful investors who advocate for investing in good companies for the long term. However, they have different strategies and approaches that reflect their individual philosophies and strengths.